The returns that mutual fund investors in India earn from their fund investments are actually much lower than the returns that those funds garner. How big is the magnitude of this problem? Why does it arise at all? And what are some of the steps that investors can take to minimize this gap? To get the answers to these questions and more, we spoke to Kaustubh Belapurkar, Director, Manager Research, Morningstar Investment Advisors India. Do watch this interview to learn more. Good afternoon, Kaustubh, and welcome to our show.
Hi, Sanjay. Thanks so much for having me.
Morningstar has come out with a very interesting report that highlights a very central problem that investors in India are not able to earn the same returns that their funds garner. Could you let us begin by give us a sense of what is the magnitude of the problem? How big is this problem across, say, categories, across asset classes?
Sure. Sanjay, I think you've asked a very pertinent question because very often, right, all of us who've been talking to investors have always faced this issue where, investors say that, look, this is what the fund returned over a period of time, but how come my returns are substantially lower than this? Morningstar has been doing this study globally where we've seen, even in developed markets like the US, there have been gaps between returns that the fund made and the investor made, right? And that's what we call the behavioral gap or the investor return gap. So we were very keen to run this from Indian perspective, given that, it's obviously the assets have been growing, newer and newer investors have been coming. And the findings that, that came across were quite eye-opening. So let me just share some numbers with you to give a perspective about how this, what the study threw up, right? So the first thing we did was we looked at the overall sort of fund industry returns versus the investor returns, which means practically all the large categories across asset classes, be it equity, debt, allocation, even commodities, right? We looked at a composite sort of fund return score and, what is the weighted average return that the funds generated. And on an average, what is the investor, every rupee that's invested in these funds earned over a period of time, right? So when you look at that, what you would see is that, say, for instance, on a 3-year basis, on an average, the funds return about 10.5%, but the investor return for the same period was only 7.8%. So that gap is almost 2.6 to 2.7%. That's significant, right? And this is CAGR, right? Every year, the investor on an average is losing to 2.6% over a 3-year basis. 5 years, similar numbers in terms of the gap, where the gap was about 2.5% on a 5-year basis across all asset classes. On a 10-year, this number is actually a lot larger at about 5.8%. That means on an average, funds return about 12.3% on a 10-year basis, but the average investor return was only 6.54%. So almost half the returns of the funds were not captured by investors. Now, I must make one point here that, given that over the last 10 years, obviously the assets have grown very significantly, which has probably widened the gap to some extent because a lot of investors have probably come in the last 3-5 years. But when you just look at the 3 and 5-year data, it paints a pretty accurate picture that the gaps are still significant. 2.5% of returns going away is a pretty significant number where investors haven't captured that part of the fund returns, right? When you break this down and look at it at an asset class level, and at any time frame, you can look at 3 years, 5 years, and 10 years. I think there are a couple of things that are very important to point out. So typically, the more volatile asset classes, such as equities, have seen larger gaps as compared to, say, a fixed income asset class, right? Which is, and we'll talk about that a little later in the show. But when we think about it, fixed income being less volatile, the gaps have been low, but the overall returns also earned by investors have been lower, right? But on equities, which is a very attractive long-term asset class, for instance, when you look at it on a 3-year basis, funds return on average 12.65%, but the average investor or the average rupee invested in the equity funds earned only 9.45%, a 3.2% every year return that was given away over the last 3 years. 5 years, again, paints a very similar picture for equities, where the gap is about 2.9%. And on a 10-year basis, it's actually half the returns of the funds. So the funds have returned almost close to 15%, whereas the investors captured only 7.5%. So almost half of the returns were not captured by the investors in equities. Another interesting asset class, I think commodities, largely gold right now. But again, I think, gold has actually seen some of the largest gaps that we've seen across timeframes, especially on the 3 and 5 years, simply because a lot of investors came into these gold funds after the sharp run up in gold prices, post 2019, because gold went nowhere from 2012-19, and then it ran up, but most of the money came up after that run up had already happened. So I think these are pretty significant gaps that that have existed on between the fund returns and the investor return. And just to give a context of a global developed market like the US, the average investor return gap, so we spoke about from an Indian perspective, it's about 2.5% over a 3 and 5 year basis. The average gap from a US market perspective is only between 1.2 to 1.5%. So there is still work that needs to be done in terms of attuning investor behavior from a local context, so that they make the right choices, they make the right investing decisions, and they reduce the gap. It's important to note that there will always be a gap. There's no perfect world that there will never be a gap, because unless all investors came into the fund at day one and stayed till the end over that time period, obviously then there will be no gap. But that's a utopian scenario. You will always expect a gap, but the idea is that the gap should be as small as possible, and that would show good investor behavior.
Could you explain why this gap develops? What are some of the key reasons?
Sure. So I think the primary reason that happens, why this gap develops, is investors are trying to time, right? So be it in asset classes, be it in categories, be it in, so give you a classic case that, a lot of money, I gave the example of gold, a lot of money came into the funds, they were not invested prior to the run up in the strategy, right? So if a fund is earning 15-20%, but you come in after that, and maybe the returns after that are flat or negative, the investor return will look dramatically different from the fund's return. The same thing goes for asset classes. So if there are poorly timed inflows and outflows from a strategy or a category, these investor gaps will open. And the more the number of people who make these wrong choices, the gaps can widen. And so it's about poorly timed, not just entries, even exits from strategies that can cause these gaps. So I think that is the primary reason, which causes these gaps. For instance, another classic case, when you think about the context of the COVID crash of March 2020, and then the sharp run up, a lot of investors were still sitting on the sidelines. Despite the correction that happened, they were probably under-allocated equities in their portfolios. But they only came in after the markets had probably already had that sharp bounce back later in the year. And, there was a gap that opened, in equity as an asset class or in any of the categories that they were invested in. So I think that's something investors need to keep in mind. Asset allocation, steady investing, staying investing, rather than making emotional decisions, is a very, very key factor of reducing this gap between what the fund has earned and between what the investor earns. Because remember, the only way you can max the fund return is if you stay invested over the entire period. So the fund made 15% over 5 years. Only if you came on day 0 and stayed till the end of the 5th year would you actually make that entire return. But if you're going in and out of funds or going in and out of asset classes, there will always be a gap that will be open. And that will happen. It's practically there will always be gaps, like I said, but can you reduce that gap? That's the key message that needs to go to investors.
Now let us discuss a few categories. In the case of equities, we see that large cap funds had the lowest gap, and technology funds and global funds had higher gap. So could you explain the reason for this?
Yeah, that's a very good observation, Sanjay. And I think the key point, right? Because if you think of large cap, there are two reasons for why large caps had smaller gaps. So one is obviously it's a less volatile category of funds. It's a more consistent return that you would look at it versus, say, the benchmark, right? So large caps being well-diversified funds, the gap would be lower because investors coming in today versus coming maybe 1 year or 2 years down the line, the experience will be a lot less volatile in that sense. The experience will be quite similar for investors coming at different points of time. The other thing is investors are largely, do invest in large caps, on a regular basis. It's not like suddenly large caps have become the flavor of the season and tomorrow something else becomes the flavor of the season. So the well-diversified funds such as large caps benefit from these two factors, being less volatile than some of these sectoral or thematic funds. And we investors largely look to invest a portion of their portfolio in large cap funds, and they're invested over a period of time, right? When it comes to the other categories, which have seen large caps, your sectoral funds, we spoke about technology funds, we spoke about healthcare funds and global funds. When you think about these kinds of funds, we've spoke about cyclicality of the markets. Different sector winners emerge every year. So what we saw in 2020 post the COVID crash, two sectors did exceedingly well, which was technology and healthcare. And in fact, technology continued their good run even in 2021, right? But what happened was, one is that the returns tend to be much more lumpier for these sector funds, right? We saw that, in the previous years, healthcare in 2018-19 were probably amongst the worst performing sectors. Investors did not invest in the funds when the chips were down for these funds, but they came into these funds or these sectors after the significant performance had already been delivered. So large part of the money that, say, for instance, came into technology funds came in the second half of 2021, when already the 2020 sharp run-up and the first half of 2021, again, a sharp run-up had already gone by. So when you just compare the 3-year returns of the average technology fund, which is about 27.5%, this is the staggering number. Investors on an average earned less than 3%. The average rupee invested in the tech funds earned less than 3%. Because when I just look at the AUM of these funds in 2020, it was, I think, about 1,000 to 1,200 crores. Today, we're sitting at about 20,000 crores of AUM, large part which has come in the last 12 months after the run-up has already happened. So those and that money that's come in after the run-up is actually sitting on flat to probably negative returns, because we know technology has been one of the underperformers this year, right? So that is the challenge that needs to be addressed. These poorly timed return chasing, especially in sector funds, that's a challenge. The same thing goes for, say, for instance, global funds, right? We've seen US relatively did very well versus the Indian markets in the last decade, but a lot of money came in towards the time when then Indian markets started outperforming. In the last 12 months, obviously the Indian markets have relatively outperformed most of the global markets, including the US markets. But investors came in after that run-up in US markets had already happened, and now they're sitting on relative underperformance, or in fact negative returns, as compared to the funds that have done actually well, the US, the Nasdaq, or the S&P 500s over the longer time periods, because the bulk of the money came after the run-up had already happened. So I think that's something investors need to be very, very cognizant of, and especially when it comes to segments such as sector funds, because they can be very, very lumpy in returns. So you have to be there before the run-up has happened, rather than trying to chase, looking at past performance, saying, "Wow, this has done so well, let me come in," because you'll actually get hit to both ways.
In the case of debt funds, we see that dynamic bond funds have a large gap, whereas the gap is much lesser in the case of shorter duration funds. Why is this so?
Yeah, again, I think very, very important point here, Sanjay, because when you think about fixed income funds, you typically think about them as being very low volatility and kind of steady expectation in terms of returns, at least when you enter the funds, right? But even within fixed income, and like you rightly pointed out, your short duration funds are a lot less volatile as compared to some of the other categories, which is dynamic bond funds or even gilt funds for that matter. And I think, again, the two same factors at play. One is that these funds will tend to be more volatile in their returns, given that both of these will have some duration element at play, which can significantly move the NAV across time periods. But secondly, again, which is the investor behavior, which becomes the crux of why these gaps are larger in dynamic bond funds. If you remember, again, the period of 2020, the first half of 2020, we had the sharp drop in yields, where obviously as the yield moved down, the bond prices move up, and the fund NAVs also increase quite significantly. On a relative basis, while there are still, in terms of AUM, smaller categories, but dynamic bond funds and gilt funds both saw, on a relative basis, large amount of assets come in, because these funds had done well and when the yields had dropped. in the first half of 2020. So a lot of investors came after that sharp run up again, the same thing. And after that, we all know that the yields have only inched up and then shot up, in the past 12 months, where a lot of these investors are sitting on flat to probably marginally negative returns. So that is the challenge, right? That if you have to allocate to these kind of categories, either you have to be able to take that directional call, like you would do with a sector fund, being early in the cycle, or you have to invest over a longer time period where you might have come late in the cycle, but at least stay invested that you can capture the next cycle. Because the worst thing that an investor can do today, who's probably bought a duration strategy, is exit now on losses when maybe the interest rate cycle, we don't know when it'll turn, but we know that market cycle will turn. It could be 6 months, 12 months, 24 months. We don't know when the interest rate cycle will turn, but it'll turn. That's when they will make returns. But the investors need to stay put through that cycle if they've already been late in the previous cycle. So I think that's something investors need to be very, very cognizant of when making investments in funds which tend to be more volatile or cyclical in their performance.
So one key recommendation in your report is that you hold a very few funds, but widely diversified funds. Could you elaborate a little on this?
Sure. So the classical sort of theory, what we talk about core and satellite allocation, right? I think this is kind of we talk about that because the numbers like we've shown that one is when you're building a portfolio, especially the core part, which should be a significant part of your overall allocation, should be those sort of widely diversified funds which will tend to be A, less volatile, and B, you can enter at any point of time and not having to worry about are you coming at a poorly timed investment into these kind of funds, given that they're more steady return sort of strategies. You want to avoid sector funds, and I think most investors are probably better off not investing in sector funds at all, especially given the perils that it comes in terms of timing or staying invested through a period where they could be flat or negative. But even if you have to do some of it, it should only be a satellite and a small allocation in some of these volatile funds. But I think most investors better served, you're buying an equity fund or a debt fund, buy those core allocation categories. And it can be a very small number because you want to diversify. We've spoken about diversification scientifically and not just buying 10 funds and thinking you're well diversified. I think that's some things that investors need to keep in mind. It needs to be well thought out in terms of well managed funds. Well diversified funds will help you actually achieve your investment goals rather than trying to continue to chase performance, which can hit you both ways, on the up and the down.
Given that sector and thematic funds are so problematic, could you tell our viewers how to go about investing in them? What kind of allocation do you make? When do you enter? How long do you hold?
Sure. So I think a couple of things. So one is if you're an investor who can has the wherewithal, and this is a very small set of investors, mind you, that who can actually take directional calls in terms of, okay, I believe now, fundamentally, I think, this sector can potentially do well. Sector funds are great tools for them because they can express a view through a very focused sort of strategy. Okay, I believe healthcare is turning around, and I want to enter now because, there's a lot of pain in the prices, but, the turnaround's coming and I can invest. It's not just the entry, it can also be the exit, right? They're great tools to express that. But if an investor who doesn't have that wherewithal to take that call and wants to make some, small allocations just to try to play that theme or trend or theme, I would, recommend that nothing more than 5% per sector or theme, and not more than typically 10%. Now, these are just, kind of guardrails or ballpark figures, but, this is typically so that you don't have an outsized part of your portfolio that is exposed to this sector or theme, which can do very well or very poorly relative to the market. So I think that's what investors definitely need to keep in mind. The other thing is look for, maybe if you want to do the sector allocation, look for themes which are currently beaten down. The last thing you want to do is invest in a sector that's already done so well in the recent history, expecting that it will continue to do well for perpetuity. We know that's not true. That does not happen. Sector rotation is a given in the market, and we've seen that over decades both in the Indian and the global markets. I think that's the other thing, that if you really want to do a sector fund and want to do a little bit of timing, look for beaten down themes and try to invest in those. And the third thing, stay invested over a market cycle. So, don't come with very short-term horizons. Market cycles can be anywhere between 5 to 7 years. Think about at least that kind of time frame and limit your allocations, like I said, in your overall portfolio to a satellite allocation rather than very significant part of your allocation.
I find this point very interesting, that go for beaten down funds, beaten down sectors, which is something very hard to do. Now, another recommendation. Please.
Yeah. So that's a very valid point, because, behaviorally we are tuned to that. If something's beaten down, it'll stay beaten down. The persistency bias, right? That persistence of a trend, or if it's doing really well, it'll continue to do well. We know that's both ways. It doesn't work. I mean, I think we've spoken about even. Ideally, anyone who invested in the healthcare fund in 2019 would be sitting very happy because they made a lot of money. Same thing for technology funds. But like we said, most of the money came into these funds after the run-up. So I think that's what investors need to look to do if they want to make that allocation. But I would say 99% of the investors are better off just buying well-diversified funds, because the fund manager will anyways take some graded, they're not going to go 0 or 100 in sectors, but they will take plus or minus 5-10% overweight, underweight calls in sectors, which a professional manager is doing it for you. You don't even need to bother that, about thinking which sector, what theme, because there's a professional money manager doing that for you. That's always a better way of doing it.
So your report also says don't go by past performance. And what does one exactly do? If one doesn't look at past performance, what does one look at?
Sure, that's a very very important question, very important point, Sanjay, because I think what happens is the past performance becomes the only metric for a lot of times for investors to choose a fund, be it a sector fund or even selecting funds within a category, right? That I believe this fund has done exceedingly well in the past 1, 3, 5 years. Let me just buy this fund because the fund's going to continue to outperform over a period of time. Now the challenges, and we've spoken about what we call this, we spoke about market cycles. There's also the style cyclicality, right? Which and we've seen this happen even in the past and in the more recent time, where, for instance, in 18, 19, and the first half of 20, anyone who had a growth and quality focus did really well during that period of time, and value funds were beaten down, right? So if I just looked at past performance, I would believe that, say, for instance, the large cap or the flexi cap space, let me just buy the growth managers because they've done really well. And a lot of investors just loaded up on growth within their portfolio. But we know what happened in 21 and year to date. Value made a comeback and it's significantly outperformed the growth strategies, right? Now, what you want to do as an investor is use past performance only as the first sort of maybe, like a filtering or a selection criteria, but do more analysis. Try to understand if the fund's done well, is there a reason because it had a good process? It is following a particular style consistently over a period of time. And there's a lot of data that's available to investors these days to make some of those analysis. And when we speak about diversification, buy funds with different styles, because that can be very useful. So if you buy a growth and a value fund, if growth's not doing well, value is doing well. If value is not doing well, growth is doing well. So that kind of diversification, the scientific diversification, can really help investors move beyond just that concept of past performance and build a constructive portfolio that can actually be an all-weather portfolio rather than someone who bought all growth funds in the year 2020 and now sitting on relative underperformance versus the benchmark and the category because they were just exposed to one style rather than being much more diversified.
So diversify across asset classes, equity, debt, commodities.
Yeah, absolutely. Yeah.
Diversify across sub-asset classes, large cap, mid cap, small cap, and then also across styles, growth and value. Now, the ever constant debate on lump sum versus SIP. Where do you stand on this?
Sure.
Why does SIP score over lump sum investing?
Sure. So let me break that down, Sanjay, into two sort of segments, right? So I think both approaches have their merits, right? And if I just look at it from an investor returns perspective, actually, an SIP, the returns on an SIP would be lower than a lump sum investing. Say if you just made a lump sum invest and you bought and hold over the entire period. So I mean, just for example's sake, if you had say a 10-year investing, into an equity fund, and you did an SIP during the same time, obviously the lump sum would ideally be, the returns would be higher than the SIP returns. But that's understandable. Because when you think about it, for someone who's looking to invest, and a lot of people, it's not like the entire money is available to you on day one, right? It will, especially people who with paychecks or who getting cash flows over a period of time, will have to make this investment at different points of time and not just buy it on day one and hold for 10 years, right? Because the amount you will keep adding. So I think that's where SIP becomes a very, very useful tool. And what the SIPs can help you do is remove that inherent investor bias, right? That, okay, I want to try to time the market, or I want to, so if you set it on autopilot, it takes away that investor behavior of trying to time the markets or getting into some of those newly, returning themes or sectors. If you're doing an SIP, say in broadly diversified funds, and you just keep adding month on month, while the overall return will be probably lower than a lump sum, had you done a 10-year SIP versus a investment in lump sum and buy and hold. But the point is, the gap will be a lot smaller than had you tried to buy it at different points of time with your own sort of analysis and merit, because then you're trying to time the market and you can get hit significantly on both ways. So I think that's where the SIP approach becomes very useful, because like I said, takes away the investor biases, and more importantly, you'll never have all the money available to you on day one to start with. So it will always be a staggered approach over periods of time when you're building an investment portfolio.
One very good news in our market is that SIP investments have touched an all-time high last month. So do you see this gap reducing, the fund return versus investor return gap reducing in the future as SIP becomes more popular?
Absolutely. I mean, firstly, I'm very glad to see that investors are increasingly taking the SIP route, making those right portfolio decisions. And definitely, I think, we will, and I expect that the gaps will reduce in the future. One is the systematic investing that's happening. Obviously, a lot of investors are being, handheld by distributors and advisors who help them make these right decisions. So I think these two factors, in terms of just maturity that the entire industry is showing, the systematic investing, is definitely going to help us reduce or bridge this gap. Like I said, there will always be a gap, but the endeavor should be to narrow it as much as possible. And I think we're headed in the right direction. There's still a lot of work to do, but at least directionally, there's a lot of things that are happening that will aid in reducing this investor behavior gap that exists right now.
Thank you very much, Kaustubh. It has been a very insightful interaction. I have learned a lot from you, as always. I hope our viewers also benefit and they make the right fund choices and make the right adaptation in their behavioral patterns, as you have emphasized.